Hey, I'm Nash Evans, CEO of Evans Energy 2, and today I'm going to walk you through our Dexter Plus One joint venture. If you're watching this video, you've either participated with us in a different project or you're somebody that has looked at some of our other oil and gas projects we've done through the years. Our main focus on this fund was to answer the question of how do you put a fund together that can help or facilitate the needs of any kind of investor that's looking to invest in oil and gas. There's three different aspects to this. You've got stock investors, people that are purchasing stock on the open market, typically major multi-billion-dollar corporations. You get into the retail write-off investors, and these are the guys that are investing in 1 and 2 well deals, taking a good bit of risk, but they're doing it for a write-off. And then you have your industry investors. These are the guys with really deep pockets and a lot of field experience, crews and rigs and things of that nature. The reason I structured the project the way I did is because this one really can facilitate all three types of investors. Because it's 6 existing wells, 2 of the 6 are already producing, and we're going to be drilling 1 well that is proven reserves. It eliminates a lot of the risk that you're going to get on 1 and 2 well deals. And in addition to that, it's a good way for somebody to buy interest in potentially 7 producing wells without having to have $10+ million in cash to do it. But the greatest aspect of all of this is the tax benefits. No matter which one of the investors you are looking at taking advantage of this deal, the tax benefits should be able to suit in every single scenario. Given the utilizing bonus depreciation, you're still going to be looking at potentially a 90 to 95% write-off on the investment. The good thing is 2 of these wells are already producing an income, and the other 4 wells that are in here that are already drilled are not far behind it. Let me explain Dexter Field to you. This field was originally developed in the 1960s by Skelly Oil. Then Skelly was acquired by Getty Oil, then was acquired by Texaco. You have got some of the top tier oil and gas companies from the 60s that took the risk. So we don't have to. The good part about it is they drilled the wells, they found the oil, they produced them, the economics have changed drastically, and it's very common for major companies to literally pack up and move to another field because it just wasn't big enough for them. Well, something that's not big enough for a multi-billion-dollar company is definitely big enough for a smaller independent, which is what we are. And given small might not be the right term to call us, it does fit the mold for a great investment. And I'll explain why. In the 60s, when they drilled these wells, they had initial production rates of anywhere from 150 to 350 barrels of oil per day. The price point at that time was $3 a barrel. These wells, over the course of a 15, 25-year period, produced anywhere from 200,000 barrels of oil to right at 1 million barrels of oil from the same wellbore. Well, Pruitt Operating drilled a couple wells and sold their position to another company, Murphy Oil. Murphy Oil was looking to allocate funds in different fields in other parts of America. It's very typical for a company all of a sudden decide, well, we're going to deploy our capital and our expertise somewhere else. That's where we come in. We use all the research and development in the history that these guys did, and we could come behind them, release the acreage, and then drill wells right in between their wells and capture the same amount of reserves at a lower cost basis and produce them at an $80 oil environment. These guys, they made the wheel. They made the car. All we're simply doing is putting the wheel on the car and driving it. That's all we're having to do here. And what you're going to see here shortly is what these wells did specifically and how close we really are and what you can see from the estimated reserves from this well. On this deal, we're offering 50 units for the total cost of $5,750,000. 1 unit costs $115,000. And the greatest part about that is the tax benefit. So if you invested $115,000, and I've done a lot of videos on taxes, so please go back and refer to some of those videos, that's going to end up saving you anywhere from $35,000 to $40,000 in taxes. So for our presentation here, and just to let you know, you do have to consult with your own tax professional. Everybody's tax scenarios are different. I'm just talking in a cookie cutter scenario, that's how it would go. So the reason that actually changes the rate of return so drastically in a deal like this, instead of breaking even at $115,000 per one unit, you really only have to get back about $75,000 to break even. But 2 of the wells are in production, 4 more are completely set up. What we need to do on those wells, we need to retest the production tubing, reset packers. Some of them need new tubing in them, new production rods. We're also going to convert some of these wells from a traditional rod pumping well to a triplex high pressure oil pumping system. It typically means that you're going to have less down days because of mechanical issues with the pumping units. More producing days, less down days, less cost of maintenance means more efficiency, which in this business typically equates to more income. And that's what we're going to go after here. But what you're going to see on this little chart here, because of the 2 producing wells and the 4 wells that we're about to get into production, you can look to get about $6,000 to $8,000 a year in income. Because you're able to write off this investment, we're going to use the break. So in a 35% tax environment, your break even is going to be closer to about $75,000. So if you're looking at $6,000 to $8,000 a year in income on a $75,000 cost basis, hey, it's not, you're looking at about 10% rate of return a year. Here is where the new well really comes into play. The new well alone, for here we put in our economics 150 barrels of oil per day. Our offset well came in 360. Yes, it is a chance, but if I told you I thought this well would come in 360 barrels a day, I think I would be misrepresenting myself. I'd rather say 150 barrels a day, and if it comes in 200 plus, hey, that's just icing on the cake. But we feel very confident that it should come in with what the standard wells in the area have done. But at 150 barrels a day, over 365 days a year, you're potentially looking at an additional $35,000 to $45,000 a year in income. So if you add the producing wells, the wells that we're about to get into production, and then drilling of this 7th well, you're looking at an income potentially between $40,000 and $50,000 a year. Don't forget, our break-even is going to be around $75,000 a year. Now you're starting to see how you can have whole field exposure without having the risk of a 1 and 2 well project. Producing wells, soon to be producing wells, drilling of a lower risk, proven, undeveloped well. One thing we've done over the years is try to make transparency the forefront of every deal that we do. My numbers sound great, my deal looks good, it's pretty, but how does somebody that has not seen these wellbores know that the information that we're giving them is factual? Well, we've done a great job here in-house trying to bring that to you in the easiest explanation as possible. And page 8 is really it. These are the 6 wells that we currently own. Well number 2, well number 3 are already in production. So you will see the current production numbers. So well number 2 is doing 12,600 MCF a month. Well number 3 is doing about 690 barrels a month in income. But we take it a step further. Each one, well 1 through 6, is clickable. So if you see the well name, just like the Pittman B1, and you were to click on the name, it'll take you to the Google Maps to see with satellite imagery what is there today, what the little field looks like, what the location looks like, the proximity to the road, proximity to our corporate office. So you can see from satellite imagery what is currently there today. Second aspect to this is probably my favorite, is the API number. The API number is like a social security number for us or a VIN number on a car. That is the number associated with the wellbore that the Mississippi Oil and Gas Board uses for the history of the well. Each one of these numbers for the API number are clickable. So when you get done looking at this video and you start to dive in and do a little bit due diligence, I'd highly recommend starting there. If you click on that API number, it will take you to the Mississippi State Oil and Gas Board. That is not us, that is a state-ran oil and gas board history website. You could see the current production, the old production, when the wells were drilled, who operated them, who owns them. So if you were to ask me, how do I know everything that you're saying on these wells or exactly what you say? Well, it is simply one click away and you have access to the whole entire database of the history of this well from the time somebody decided they wanted to drill it to the time they plugged and abandoned and shut the well in. Page 9 kind of correlates with page 8. It is going to be the Google Earth image of the field so you can really move around and see all of these wells at one time. So you can go well to well, zoom in, zoom out, and you can see what we're seeing as an operator of being able to have control of multiple wells in one logistical location, being able to utilize one crew, one workover rig, one swab rig, and be as efficient as possible. And then you can also see, we're talking about the other producing wells that we're going to drill our new well next to, how close those wells truly are from where we're going to drill our new one. We get into page 10. This map, at the very top of it, is the map from the Mississippi Oil and Gas Board as well. It is unaltered. The only thing that we did to this map was put a little bitty box around the area so you can easily identify where we're going to be drilling our new well. And we highlighted in yellow the wells that you'll own in the partnership for this project. Look at the bottom part of this. Now we're going to focus a little bit more on the new well. On the left-hand side of the map, in red, you're going to see a pin for the McGee number 2. That is the well that did about 900,000 barrels of oil. And you're going to see the Sorrel number 1 and the Shows unit number 1. We are almost literally in line with them. And if you move to the right, this is the structure map. So there's been a lot of history and a lot of research over the years that came to this. 20 years ago, technology was not as pretty as it is today. For you to see this beautiful video, this beautiful map, this is the original working structure map that we show, and it actually proved to be right. So if you were to look at the McGee number 2 in its production and where the sand height was, the depth, and the cumulative production produced, our maps, prove up. On page 11, we're going to talk about the cross-section. And what the cross-section is simply correlating other producing wells, and we're using those correlations to determine where we should drill our well. To the left-hand side of us is going to be the McGee number 2. And at the very top, we're going to get a little bit into details, so if this is not your expertise, you can fast forward to the next section. But the very top line there of numbers under McGee number 2, that's your API number. Directly below that, you're going to see PERFS. That stands for perforations. That is when they open up the holes in the well to let the production flow into the well so you can produce it. That is the depth that they opened it up. If you move a little further down, it says IPF, and that's initial production flow. The McGee number 2 initially produced 348 barrels of oil per day. Like I was talking about on another page, we're targeting 150. Yes, there is a high degree that it could come in over 150, but it also could come in under 150. I know with confidence that I say if we estimate with 150 barrels a day of production, that is a very feasible number to obtain. But if you scroll down a little bit further, there in yellow, you're going to see CUM. This is our cumulative production. This well produced a little over 900,000 barrels of oil. Don't forget, it was drilled in the 60s at a $3 oil environment. Move over to the right, you'll see the prospect well. This is the well that we're looking to drill. Move to the right a little bit more. The Sorrel number 1, same deal, cumulative production, a little over 250,000 barrels. Move over to the right again, cumulative production 367,000 barrels. That is so crucial to this deal is the time when they were drilled. These guys were making great money at a $3 oil environment, coming in anywhere from 100 to 350 barrels of oil per day. But there's an aspect to this that you're not going to see at face value, and it's a term that we like to use called HBP, which stands for held by production. The reason these 3 wells were drilled so close to each other is because it is stacked pay. You have multiple different intervals that have oil and gas in them. So if you look at the McGee number 2 and you go down about halfway on the page, you're going to see a yellow line, a red line, and a blue line. This well produced majority of its oil in the blue section, which is the bottom lobe of the Tuscaloosa, called the IBA sand. Move to the right to the Sorrel number 1. They produced from the upper lobe of the lower Tuscaloosa, which is going to be your Good Friday 1, the little yellow sand. And the Shallows unit number 1 is the Good Friday number 2. The biggest thing you're going to see here, when you drill a successful well, you hold that formation held by production as long as you're producing it within certain terms of the lease. The other companies had leases very close by but didn't have rights to produce because he was already producing from that one zone, but they knew he had very successful other formations uphole. So they would drill next to him and produce the formation above. So if he's producing a formation C, the next well's producing a formation A, the third well's producing in formation B. These guys were capturing this 250,000 to almost 1,000,000 barrels in reserves from 3 different formations. Because they shut the wells in and we're drilling a brand new well and we've attained all the leases, you're actually getting the possibility of capturing all 3 reserves in one pipe and obtaining production from all 3 formations. So when I was saying prior, and you'll see this in the geological write-up, that the wellbore integrity should go out before the total reserves are met, that's why. When we're done producing one zone and it's no longer economical, well, guess what? It's not show's over. It's just, hey, it's time for us to move up hole, and then vice versa. If we drill the well properly, which we've got a track record of 650 wells of drilling them properly, and with good infrastructure, proper production treatments, these wells can really last 30 years. And that is fully what we anticipate from this prospect well that's drilled smack in the middle of 3 very successful wells. Page 15, we're going to talk about drilling of this new well. What you're going to see at the very bottom is we have allocated a little under $3 million to drill, test, and complete this new well. Our experience is in drilling, and with over 650 wells, we've learned a lot. If you can think of it occurring while drilling a well, I can assure you we've had that scenario happen. But you're going to have 3 different parts to this proposed budget: pre-drilling, drilling of the well, and then completion. You only complete a well if it's successful. And then you have to prep the location and do legal work and land work, acquisition work before you're able to drill it. The biggest part is the post-drill figure. If we go and drill this well and the results are not what we want, which again, we have a hard time believing that to be the case on a deal like this, this amount for the post-drill will be credited back. We try to be transparent on our numbers as well. So if there's a cost savings to us, it will be carried forward to you on your joint interest billings. This work is turnkeyed within the standard drill test and completion for this well. In page 16, we're getting into the people that we work with. When you're buying into a deal that we have, you're buying into our history, our experience, and our experts. And these guys have resumes to follow. They will be on the ground, day in, day out, rain, sun, shine, 110 degrees, 10 degrees. These are the professionals that make sure you're getting work done to the highest degree of quality that we can get. In page 17, going back to due diligence. We're a family-owned and operated company, and you'll see that if you do any form of due diligence on us. But underneath it, we give you a quick link to the Mississippi Oil and Gas Board. We created an oil and gas calculator. So if you do know your specific tax scenario, you're able to go to oilandgascalculator.com and you could put in your investment amount. So if you're looking at 1 unit, if you're looking at 5 units, you can put how many units you want to run a calculation on, how much is a unit, what % working interest it is, what your tax scenario will be, and it will show you within a couple dollars of how much you can look to save in taxes and how that also helps your rate of return. Then what you can do is we have 4 different calculators on the website. You can do a estimated rate of return based on $80 oil, $70, $60, even $40 a barrel, or $200. That's one thing we don't know, but as a family and as an oil and gas company, if we can't make money at 40, not break even, if we can't make money at $40 a barrel, we don't do it. I hope you found this walkthrough very informative when it comes to looking at the Dexter Plus One joint venture. The reason we are able to get deals like this is not because we're your typical company that goes to an auction, buys a field or buys acreage, and then looks to put something together. This is the result of 40 years of experience that my dad has had, 10 years of experience of me dealing with capital and partners and funds, that we're able to put all of our expertise together. And when these deals come up, we're typically the all-cash buyer, the first buyer, and we purchase these deals in distressed times. So when you are in the $80 oil markets and when people are looking to diversify out of standard investments, we have got some of the top tier oil and gas investments that you could take advantage of. We hope that you can partner with us. We would love to earn your business. Give us a call, send us an email, and we would be happy to walk over anything with you. Thanks for watching.